Where are you seeing things these days, and how important is that in your due diligence in seeing if the borrower or the business owner is likely to pay on that note on a regular basis?
Well, the business has to cash flow. So, there's different what we call notional levels of cash flow, and the smallest businesses are sold on multiples of what's called seller's discretionary earnings. And most small businesses sell for between 2 and 2.5 times that number. When they get bigger, they sell for multiples of EBITDA. And then you can get numbers with a higher multiple, like 3, 4, even 5, depending on the industry and the type of business. But you're usually talking about businesses with cash flows in excess of $700,000 when you start to talk about that bucket. So they're significantly bigger. They usually have more in the way of like middle managers, supervisors, like a quote unquote real business machine versus the smallest businesses, which are basically conducted by their owners. Like
Yeah.
it
Mom and
I
pops.
always use the example of an orchestra and the conductor, right, like that conductor is making sure everyone's playing their instruments together, and if something happens to that person or if they're distracted, the music won't be nice, and that's the cash flow, right? And so the cash flow has to be there. If somebody overpays for a business, and it happens all the time, it's one of the biggest risks that there is in buying a business. What ends up happening is people forget certain things. So I mentioned that they sell for these notional levels of cash flow. Seller's discretionary earnings is one of them, and it's the most common. And we get to seller's discretionary earnings by taking the net income of the company, and then we add back interest, taxes, depreciation, amortization, and the owner's salary. And then you end up with a number. Maybe it's 300 grand. And that's the way business brokers will advertise the business. They'll say this business produces $300,000 of seller's discretionary earnings. People will get into a deal to buy that business thinking that they will at some point have 300,000 in their hand, and you never will. And the reason is because if you operate the business successfully and profitably, you will have to pay interest on your loan. You'll have to pay taxes to Uncle Sam. You will have to take home money to feed your family. That's a salary. And the equipment and machinery slowly wears out over time and it's going to have to be replaced. And that's what depreciation represents. Accountants show you things wearing out with depreciation. So those things are real expenses. They've got to be paid. But we value businesses based on that seller's discretionary earnings just because it's so hard to compare one business to another.